The next several slides deal with working capital, so I'm going to spend just a brief introduction of how we calculate working capital and then talk about how we use that in these problems. So working capital is just defined as the current assets minus the current liabilities on the balance sheet. Now you should remember some from your accounting classes about the balance sheet. So the balance sheet is assets equals liabilities plus equity, right? And with assets and with liabilities, we have two kinds. We have current assets and current liabilities, and then we have long-term assets and long-term liabilities. Long-term assets are called fixed assets because they sit in place. So one thing I think about it, we look at our current assets. There are things like cash, inventory, accounts receivable. We don't expect them to stay around in the business very long. So for instance, inventory, if this is Glenn's Discount Liquor, that's the bottles of tequila and whatever else I have to sell. I don't want that to stay around very long because I'm in business to sell those. I expect that inventory to be sold soon, right? The cash, I don't want to keep it around very long. I'm making money. I'm going to take it out of my business and spend it, or I'm going to return it to my shareholders. There's no sense having a business if all I do is pile up cash. I want to do something with that cash, right? And then accounts receivable represents money that people owe me on short-term transactions. I sold them something and they pay me for it at the end of the month. So I don't want that to stay around very long either. I want to get paid for that stuff. And so all of these are current assets. They're short term. I don't expect them to stay on the books very long, right? And now the fixed assets are long term. They're things like the equipment, the property, the buildings, the cars, the machines, whatever I have to do my business. And these I expect to stay with my business a long time. If I buy, I don't know, a margarita making machine, and I have a business selling frozen margaritas, then I expect that machine to stay in my business a long time. It's a fixed asset. It's going to stay there, right? It produces something for me. It stays around, right? Now, working capital, I'm dealing with the current assets and the current liabilities. So in this example, I'm showing you my current assets. Total current assets are $25.50. I've also got liabilities here. I have some liabilities that are short-term. Accounts payable is money that I have to pay soon. It means I bought some stuff and I didn't pay for it right away. I said, hey, bill me for that. I'll pay you at the end of the month, right? But I'm going to have to pay those soon. Short-term loans mean I went to a bank and said, look, I need a small amount of money to get me through the next several weeks until I get a lot of payments at the end of the month for whatever reason. But these are loans that I'm paying back in a year or less. So the short-term stuff, those are my current liabilities. And then I may have some long-term loans, some things either bonds that I've sold or long-term debt that I've negotiated with a bank. And those are just longer term. So the net working capital is the current assets, the short-term assets minus the current liabilities, the short-term liabilities. That's the definition of net working capital. All right, so in this example, you can see that my net working capital is $1,250. It's the total current assets minus the total current liabilities. All right, now what we care about in terms of doing these problems is the change in net working capital. Because when this changes, it changes our cash flows, right? So if the change in net working capital is positive, if it gets larger, that's using cash, and if it gets smaller, that's providing cash. So we'll talk about that more in the next couple of slides. But I just want to go through this. This is how we calculate net working capital. And what we're concerned about is how it changes from one year to the next. That's what affects our cash flow. Okay, so I've got an example here of working capital over a 3-year time period. So I've got current assets and current liabilities. The question is, what's the change in net working capital from year 1 to year 2, right? So the first thing you look here is say, well, let's see, working capital in year 1 is going to be current assets minus current liabilities, so it's going to be $100. And then in year 2, it's going to be current assets minus current liabilities. And I'm not the greatest at doing math in my head, but I'm assuming that's $130, right? So the change in net working capital from year 1 to year 2, well, I take the value in year 2, $130, minus the value in year 1, $100. And that's a change of 30. So the answer here is B, right? My change in net working capital. All right, net working capital increased by $30. And by the way, this uses cash. So since it got bigger by $30, my cash flow is smaller by $30. Right? Okay, and then what's the change in net working capital from year 2 to year 3? Let's see, 130 here, and then, gosh, I'm terrible at math in my head. I'm assuming that's 90. So I went from 130 to 90. My net working capital got smaller in this case. I'm assuming it's 40. So yes, it decreased by $40. It got smaller. 130 to 40 is getting to 90 is getting smaller by 40. And this actually provides cash. This means it provided me with positive $40 in cash flow. It would affect my cash flow by positive $40. All right, so yeah, I've got a point here. If working capital change gets bigger, if it's an increase, then it's reducing your cash flow. The effect on cash flow is negative, and the opposite if it decreases. Okay, so there's a question here about the net effect on a firm's working capital if you have a new project here, and when you look at how it's going to affect working capital, you say, well, I know that when I put this new project in place, I'm going to have to increase my inventory by a certain amount. My accounts receivable are going to go up a certain amount. I'm also going to have to buy new machinery, and I'm going to have a $20,000 increase in accounts payable, which is a liability. Right? And so we can walk through these. Remember, the net working capital is current assets minus current liabilities. So I have a $30,000 increase in inventory. That's increasing my net working capital by $30,000. And that's a current asset that gets larger. There's a $10,000 increase in accounts payable. Right? That again is a current asset that gets larger. So it's going to increase my net working capital by $10,000. There's a $35,000 increase in machinery, but that's not a current asset. That's a fixed asset, so it doesn't go into our calculation. Accounts payable increased by $20,000, but that's a current liability. We're subtracting those off, so that will reduce my net working capital requirement by $20,000. So the total will be the sum of these. I'm going to have my current assets will go up by $40,000. But my accounts payable will go down by $20,000. So the net effect is going to be a $20,000 increase in net working capital. And that's going to require cash. Right? That means I'll have to spend $20,000 to support my net working capital in this case. Right? But the answer here, what's the net effect on a firm's working capital, is C, $20,000. Okay, now I've got slides out of order here, and I didn't mean to do that. So before I talk about this problem, let me talk about this slide here, and then I'll go back and look at that problem. We generally have two methods for dealing with net working capital. One is the easy method, and we use this a lot just to keep things simple. And what we say is that we assume that projects will require a certain amount of net working capital at the beginning, and then it'll pretty much stay constant until the end. And then at the end, we'll get it all back. So in other words, we'll say a project requires an investment of $10,000 in net working capital. And then it won't say anything else about net working capital. And if that's the case, then you can assume it's this type 1, the simple case, right? And in that case, you spend the net working capital at time 0. That is, net working capital increases by, in our example, the $10,000 at time 0. So that's a negative effect on cash flow. You need that much money to build up net working capital at the beginning. And then at the end of the project, say it's a 5-year project, you assume you get all that net working capital back at the end. So you assume that when the project's over and you shut everything down, then you won't need that net working capital anymore. That's cash that will come back to you, right? One of the ways I think about this is spare parts for a machine. If I'm buying a machine and it's a large, complicated machine, then I'm also going to have to go out and buy a lot of spare parts for it so that when they break, I will immediately have a part there to fix the machine and keep it running. And that costs money. I have to go out and buy all those spare parts. I have to keep them in the warehouse. And then when I use one, I immediately replace it with another one because I've got to keep those parts on hand just in case. Right? So as long as I've got that machine running, I've also got all those spare parts I had to go out there and buy. At the end, when I'm done with that machine, I shut it down and maybe sell it or give it back or whatever. Then I'll also give back all of those spare parts. Right? So I'll get all the money that's tied up in them back. Right? So That is the case where we use the simple method. You just assume all the net working capital is spent at the beginning and you get it all back at the end. Right now, we do have a few examples here of more difficult net working capital, and that's where because for whatever reason the project's a little more complicated and the amount of net working capital we need is going to change every year. All right, and you'll be given some way to calculate how much your net working capital will be every year, and then you're going to have to calculate the change in net working capital every year. All right, and figure out the effect on cash flow as that goes by. Right? We'll do an example looking at that. Okay, so let me back up a slide here. It says, how does net working capital affect the net present value of a 5-year project if working capital is expected to increase by 25% and the firm has a 15% cost of capital? Right now, all it told you was that net working capital was going to increase by 25%. It doesn't say it, but it's implied at the beginning, right? And so what you know is that, all right, we're going to need this $25,000 in increase in net working capital at the beginning. We will get it all back at the end. So 5 years from now, we'll get it all back, right? So since it's asking about net present value, we need to look at these in terms of present value. What happens is we're going to spend $25,000 at time 0. We're going to receive $25,000 5 years from now at the end when we get that net working capital back, right? And so to show you those calculations here, it's like this. At time 0, I spend $25,000 and then nothing happens with working capital along the way, but at the end I get $25,000 back from that working capital. Now the total effect on net present value would be the present value of these two. Right now the present value of spending $25,000 today is just spending $25,000, all right? But 5 years from now, that's going to be different. We have to find the present value of that. The cost of capital, which is the same as the discount rate, is 15%. So I'm going to take that $25,000. I'm going to divide it by 1 plus 15% raised to the 5th power. I get that much money. And so it's the sum of those two, minus 25,000 plus the present value of 25,000 received 5 years from now at a discount rate of 15%, and that is a negative $12,570. So there's the answer here, right? And it's negative. That's why the answer is decrease, right? It's a negative effect, decrease by 12,571. Okay, so there's the simple case of net working capital. Yes, and I've got it worked out here on the slide too. Okay, worked out here on this slide, those same numbers. Okay, here's one for you to practice. I'd encourage you to practice this. Net present value of a project that cost $100,000 provides $23,000 in cash flows annually for 6 years. Now notice the wording here. In cash flows annually for 6 years. When you see the word cash flow, that's a good thing. That means I've figured out cash flows for you. You don't have to go and figure out all of that about depreciation and earnings before taxes and all of that. I figured that out for you in this problem because I'm just trying to get you to focus on the net working capital effects, right? So in this case, it requires a $5,000 increase in net working capital, and it doesn't say anything else about net working capital. So you can assume that you spend the $5,000 at the beginning at time 0, and you recover the $5,000 at the end, right? And the project makes $23,000 a year for you over 6 years. So let's just talk about that. I can use the same template here and just add a 6 to that. So clear that out. So we're going to spend at the beginning $100,000 for to buy the project, but we also have to spend $5,000 to get the net working capital. So minus 5,000 net working capital. So we're going to spend $105,000 at the beginning. Then we're going to make $23,000 a year every year for 5 years. All right, and then at the end, we're going to make the same $23,000, and we're going to get the $5,000 in net working capital back. All right, And so we actually get $28,000 at the end. And at a discount rate of 14%, I'm going to solve it using Excel, but you could put these in your cash flow button, cash flow 0, 1, 2. I guess you would probably put in cash flow 1, and then you've got 1, 2, 3, 4, 5 of these. Remember, the last cash flow is 28,000, right? So I would have those and subtract that off, and that's minus 13,282. And there's the answer there, B, right? Minus 13,282. So there's a good problem to work through with those cash flows. And I've got them worked out here, what you would put in the cash flow button to solve that. Okay, I'll pick up here with the next recording with a long example that has more net working capital details.